Good afternoon, everyone. My name is Luke Tannen, and I'm the Executive Director of Chicago Innovation, an organization that supports local innovators and entrepreneurs. And I might add, a very proud partner and customer of Wintrust. Now, on behalf of Wintrust, I'd like to welcome you all to today's virtual event, the Economy, Taxes, and Election Day. Certainly some very big topics that affect all of us. Before I introduce today's speakers, I'd like to let everyone know that if you have a question, you can send it to us via the Zoom Q&A while the event is taking place, so our speakers can see what is on your mind and they will try to respond to it. And then also keep an eye out for a few polling questions because we want to hear from you, the audience, as well. Now, on to today's speakers. Our moderator for today's discussion is Tom Zadar. Tom serves as Chairman and CEO of Wintrust Wealth Management, overseeing 4 operating business units: asset management, trusts, investments, and 1031 exchange. Tom is in his 15th year with Wintrust, and he joined the company after a long career in financial services that included investment banking, management consulting, and then 9 years with ABN AMRO's LaSalle Bank here in Chicago. Our panelists include Jason Turner, who will address the state of the U.S. economy and what economic impact the upcoming election may have. Jason is the head of multi-asset strategies for Wintrust Asset Management Group and is a member of the firm's investment committee. He's primarily focused on interpreting economic and market conditions to create investment solutions and strategies for institutional and individual client portfolios. He's a regular on WGN's Business Lunch Hour radio program and does frequent public speaking engagements on the markets and economy, including recent presentations to the American Diabetes Association, Illinois Government Finance Officers Association, and the Illinois Restaurant Association. Also on our panel today is Dan Rahill, who will be discussing potential tax law changes pending the outcome of the upcoming election. Dan is a managing director and senior vice president at Wintrust Wealth Services, where he works with clients to determine their financial objectives and develop strategies for their tax, estate, investment, philanthropic, and family capital needs. He is often published and quoted in publications including the Chicago Tribune, Crane Chicago Business, ABC7 TV, Yahoo Finance, and the Illinois CPA Society's Insight magazine. Dan is a former chairman of the Illinois CPA Society, and he serves on 3 academic advisory boards and several nonprofit boards and committees. And with that, it is my pleasure to turn it over to our moderator, Tom Zadar.
Great, thank you, Luke. And welcome to all who joined us for today's discussion, Wintrust's inaugural quarterly economic panel discussion. Today we'll be addressing the economy, the upcoming election, and finally taxes. Let's jump right into the economy with Jason Turner. Jason, the COVID-19 virus first hit the United States about 7 months ago, and the resulting pandemic has had a devastating impact on the U.S. economy. Can you give us an overview of where we stand today and how the economy is doing right at the moment?
As hard as it is to believe, over the last 7 to 8 months, it feels like 5 or 6 years, we started this year continuing a growth path, a strong growth path we were on in 2019. We actually saw equity markets nearly up 5% by early February. However, as a result of the global pandemic, we saw GDP decline by nearly 40% between the first and second quarters of the year, as consumer spending, which is the lifeblood of the American economy, as a consumer-driven economy, some 70% of our growth comes from consumer spending. It dried up to nearly nothing. We saw retail sales fall their largest amount in history. Markets also saw their fastest decline into a bear market in history, even surpassing the speed of the fall in 1929. After the lockdowns that drove many of the restrictive economic policies ended, the economy did see a rapid jump. Markets moved a little earlier, actually in April, in anticipation of a return towards normal in mid-year. However, that return towards normal and strong economic jump was followed by additional waves of the virus, one of which we seem to be mired in even through this week, from summer and now into fall, continued pressures on the employment market, and some uncertainty driven by uncertain course of the recovery and uncertainties around the election. We're likely tomorrow to see a GDP result reported for the third quarter that's more than a 30% jump in GDP. And while on the surface that sounds pretty amazing, we need a better than 50% jump in GDP from where we sit to get back to where we were at the start of 2020.
And that leads us into our first question to the audience concerning the ongoing economic recovery, Jason. So Paul, if you could pull that up. We have we're going to have 3 polling questions this afternoon. So the first one is about the U.S. economy. And you can see the question is, when do you think the U.S. economy will return to pre-pandemic levels? And we measure that in terms of GDP, or the gross domestic product. And we have 5 choices here: mid-2021, the end of 2021, mid-2022, the end of 2022, or in 2023 or later. So take a moment, if you could, to fill in your choice there, and we'll go on to talk about the economic recovery. So Jason, back to you on this. You've long stated that you think the key to a recovery lies in improving consumer confidence. Where do we stand on that particular metric today?
If we look at consumer confidence, we're really looking at 2 different numbers. The University of Michigan's Consumer Sentiment Index is the one I've been following most closely. That one was recently reported up at 81.2 for the month of October. Now that's off a low of 71.8 that we hit back during the depths of the first round of the virus. The average is somewhere in the upper 80s. A healthy number, I'd say, is actually north of 90. But this sort of underscores a concept that I've been pretty consistent with since this whole economic downturn started, and it's an idea of forestalled versus foregone spending. In 2008, when we came out of that recession, because of the real estate and debt bubble bursting, a lot of spending that people had planned to do based off of that extra debt was foregone. It didn't come back into the economy until years and years later. What's happened here is an idea of forestalled spending, where spenders have sat on dollars. We've seen the savings rate increase significantly throughout the middle of the year. Even some of those checks that were sent out back in the spring, people sat on and have waited to spend. We've certainly seen instances of that in auto spending and the like. But once we see consumers feel very confident about the direction of the economy and the country, we're likely to see that spending unleashed and a pickup and more rapid recovery emerge.
So Jason, what level do you think we need to get to in order to signal a full recovery?
I think it's important to note in talking about any level of full recovery, we are starting at a higher point than we did in 2008 and 2009. Coming off the last recession, we'd actually reached a level of 55.8 on that sentiment index. So starting from that 71.8 level, if we see numbers north of 90, that would start to be reinforcing of that idea that consumers are confident, and some of that forestalled spending is likely to come back to the economy.
You know, Jason, you noted the concerns over a possible second wave of cases of COVID-19 as we head into the winter months here. What are the most significant risks to our current recovery that such a wave would pose in your view?
And we've seen the numbers of the last several days certainly bring this to the front of everyone's mind. And in my mind, there's 3 main risks that I would highlight for a increase in COVID or a second wave, if you will. The first is any sort of return to restrictive lockdown policies like we saw in the spring is likely to induce a second economic fall. I think we've learned a little bit in terms of their efficacy and their impact on virus spread, but also in terms of their economic impact. And we're pretty confident that such a policy change would induce a second economic decline. The more top of mind one for me is erosion of consumer confidence. Every time we see a spike in virus numbers, we see a decline in the confidence numbers. The other consumer sentiment number I mentioned is the Conference Board's number that was released this week and showed a slight pullback in consumer confidence, partly because of the most recent spread of the virus. The longer term impact that concerns me is the trend of unemployment or a return to full employment. We've certainly seen the unemployment picture drag out longer than any of us had hoped it would in terms of those furloughed positions from the spring. Many of them turned into permanent unemployment or permanent separations, and high levels of unemployment do have a significant long-term drag on the economy. The longer this continues, the more economic drag we'll see from the employment situation. Yeah.
Understood. Thanks, Jason. Yeah, let's take a look back and see how our audience rated things in our polling question. Let's see. That's actually pretty third of a third, end of 2021 and mid 2022. So pretty consistent, and not a lot of people thinking it lingering much longer. So interesting from the audience here. Dan, what is your take on things and when we should or could expect a full economic recovery?
Well, Tom, I'm going to give you two answers, and the reason for that is it depends on how soon we can get stimulus or not out of Washington.
Yeah.
I am one of the third respondents that thinks that with stimulus, if we can get a stimulus package through in early 2021, that by the end of 2021 in the fourth quarter, we'll be on our way to a very nice recovery that gets us back maybe to where this all started last January, February. However, if we cannot get a significant stimulus package out of Washington early in 2021, I see this going into 2022, maybe the end of 2022. So much more of a long-term dismal forecast if we can't get any stimulus passed.
Yeah, makes sense, Dan. Yeah, Jason, what do you think here?
Well, I agree with Dan in terms of the short-term resumption of end of 2019 GDP levels. I think the more concerning thing for me or top of mind for me is looking at the growth path we were on running through the end of 2019. And to be fair, we'll take the first 3 years of the Trump presidency and the last 3 years of the Obama presidency and forecast that growth rate forward. And if I do that with stimulus, we don't return to that growth path until sometime in mid-2025. Without stimulus, you're looking towards the end of 2026 before we resume that growth path. So great first step in getting back to end of 2019 GDP levels. But for long-term economic health, I've got my eye out at 2025 and 2026 when we get back onto that growth path.
Yeah. Thanks, guys, on that. You know, I'm going to take a quick question from the audience that came up, which is I think came from one of our bankers asking about our clients, saying that they're seeing a lot of information coming from all directions. And I assume he's talking about both COVID and economic data. And the question is, you two guys, where should we be telling folks that we should get the most verifiable or reliable information and data? Maybe where you source such information?
Well, I think that's one of the great questions that we have in terms of the amount of information that's flying around right now. There's a lot of differences in terms of economic forecasts. And what that tells me is there's a lot of uncertainty. There's a lot of assumptions being made in terms of the direction of things from an economic perspective. Try to trend towards things that are nonpartisan in terms of your sources. You know, think tanks that exist on the left and the right tend to be biased towards themes of the left and the right. But content that you're going to get from any large Wall Street firm, from a nonpartisan group, think tank, those are going to be fairly reliable in terms of what we know now. But the important thing to know, I think, is that we don't know everything now. There's plenty of uncertainty out there that could change those directions in the short term.
Right. Dan, anything to add there?
No, I agree with Jason. I think that any data that we look to for any sort of comfort has to come out of the big Wall Street firms, universities like University of Michigan, data on consumer confidence. Those are the sources, the nonpartisan sources we need to look at. And those typically are the webinars and the seminars that I've been attending, and Jason and all of us the last few weeks, trying to get our feel for where this stands.
Okay, great. Thanks, guys. Now let's change gears here and start talking about the election. With election day actually less than a week away, there could be dramatically different economic outcomes depending upon how the voting all shakes out. President Trump and former Vice President Biden differ considerably in their tax and fiscal plans. Furthermore, depending on what happens in the congressional elections, we could see some significant legislative changes in the very, very near term future. So with that said, let's post our second polling question to the audience. Paul, if you could bring that up. And again, this is basically, how do you think the upcoming elections will play out? And we assume here that the Democrats retain control of the House of Representatives as they have a significant majority, but it's really a question about the White House and the Senate. So our polling question is, how do you think the upcoming elections will play out? Republican president and Senate, Republican president, Democratic Senate, Democratic president, Republican Senate, or Democrats in both the president in the White House and in the Senate. So take a moment, please, to respond there. And I'm doing the same. So let's hear from our panelists on this topic. Jason, I'll start with you. because I know you follow this closely. What are the polls suggesting the likelihood is of each of these potential outcomes?
And one of the important things I think I want to underscore is we learned in 2016, and then again in the Brexit situation in the UK, that polls are highly unreliable, at least in modern times. So I've switched from using polls to using betting markets. I think you've seen betting markets get the Brexit solution right. I think you saw betting markets get the presidential election in 2016 right. So I'm watching betting markets. And one I've spent a bit of time keeping an eye on is Predicted. They have a high daily volume of bets on there, between 600 and 700,000 on a daily basis, even over 1 million in some cases. Looking at that data, it puts an approximate 61% probability of a Biden victory in the presidential election, 39% for Trump. More impactful, though, is likely going to be the result in the Senate, whether the Democrats take control in the Senate and can move forward in some sort of unified way from a policy perspective. Right now, those betting markets place a 58% probability of a Democrat-controlled Senate and House, and a 28% chance of a Republican Senate and Democrat House. And those of you that are astute with math realize that number doesn't add to 100. There's still, of course, some people hedging their bets out there in the betting markets looking for, or a red wave or some sort of Republican control that's outside the realm of probability. But if we translate those to probabilities, and there's some contingencies there, about a 50% probability of a blue wave, a 40% chance of one of the split scenarios, one party in control of the presidency, one in control of the Senate, and about a 10% chance of a Trump second term with a Republican Senate. Again, based on those betting markets.
Got it. Great. Thanks, Jason. So, and again, the blue wave scenario, just to be clear, because we'll refer to this later, is Democratic president, Democratic controlled House of Representatives as it is today, and a Democratic Senate. So, Dan, I know you are also on top of these predictions. What are you hearing on this front?
Well, following Jason's lead, I called my bookie. Because I needed a reliable answer to your question. What do the betting markets say? No, I probably even, Jason hit some very exact data. Anecdotally, I've sat in on a lot of what I feel are reliable discussions around this question. And I'd say it's 70% of a blue wave, 70, 80%. From what I've heard, reliable sources say they think that the chance that Joe Biden taking the presidency on a standalone basis is in the 80 percentile chance. And the Senate, while less than that, less than 80%, even if it's 70, you're talking the chance of a blue wave being significant. So it's more than more likely than not, 51% chance that there will be a blue wave. I think it's significant. I think it's at the 70% level.
And I think if I add one thing there, Tom,
Sure.
One of the interesting results in that betting market and not having to call my bookie and just looking at Predicted, that level of votes or bets has actually been rising more in the condition of, will the Democrats control 51 seats or more than 53 seats? There's more activity in that betting pool over the last 4 to 5 days than there has been on the blue wave versus split Senate and House.
All right. Well, let's go back to the polls and see if our audience agree with the betting markets and Dan's bookie. All right. 32%, 36. All right. So it is it's actually in orange here, but it is our blue wave down at the bottom. Is the largest group thinks that the Democrats will control all three pieces of the puzzle here. But there is a pretty decent split vote there between the Democratic president and the Republican Senate. Interesting. Okay, so the blue wave at least wins out from our group of voters. We have, it looks like, more than 262 people on the line right now. So I'd say that's statistically significant. Now, there is, Dan, I'll go back to you on thinking about party alignment. If you do have a split in the White House, in that scenario, major changes are more difficult to come by, for sure. In the event that you do have that split control of the presidency and the Senate, how likely do you think it is that we'll see material tax law change?
I don't think there's much chance of material tax law change, Tom, in the next 2 years if we've got a split control, as you said. I do think there are certain areas that they can agree on and reach across the aisle. Obviously, stimulus is needed. The president actually has been a strong proponent of stimulus, we believe, and that just hasn't gotten done before the election. So I think within those packages, and infrastructure is the other area that I think both parties feel strongly about, that there could be some tax change within those bills that move forward in early 2021. But the word material change, no, I don't see any material change in tax law happening for another couple of years if that's the scenario.
Great. Thanks, Dan. And Jason, the other economic driver that will be affected by the outcome, as Dan mentioned, is this fiscal stimulus. Should we have a blue wave outcome as predicted from the elections, what do you see happening in terms of that future economic stimulus?
I think in reading the tea leaves for what the Democrats might do, the stimulus would be top of the ledger in terms of activities for the new Congress once seated in January. So in terms of timing, that's probably the first major bit of legislation out of the gate, out of Washington with the new Congress. The numbers that have been thrown around are actually quite amazing. We've already set up $3 trillion in stimulus earlier in the year. We're likely to see another 3 to 4 trillion. I've even heard numbers exceeding 5 trillion in terms of the magnitude of a fiscal stimulus package in early 2021. The focus of that, I think, is the big difference between the Republicans and the Democrats. The likely focus for a blue wave stimulus scenario would be a significant amount of demand side stimulus, meaning stimulus targeted at consumers. So that's unemployment support, that's checks to individuals, that's small business support, that's potentially even support for state and local governments. That's something that, you know, the other side of the aisle has been very against in terms of the stimulus discussions here this fall. We're very likely, as Dan pointed out, to see a significant infrastructure spending bill focused on the green economy, but also focused on building up roads, bridges, and areas of traditional infrastructure within the United States. I think it's easy to see $1 trillion in infrastructure spending, potentially as much as 2 or 2.5 trillion in terms of infrastructure spending spread out across 2021. And that may be the largest economic impact out of the stimulus in terms of long-term economic benefit.
All right. Let's move on, speaking of economic benefit, to our last topic, economic prospects and potential tax law changes after the election and their implication for individuals, business owners, and investors. Dan, this is your area of expertise. Much has been written about Mr. Biden's tax proposals recently. What are the significant potential changes we could see if he secures the presidency?
Tom, for sake of brevity, and this will take a minute to go through or more, I've broken it down into 6 key areas that we will focus on for the rest of this call. And the first potential change, significant change we could see from a blue wave and a Biden presidency would be obviously individual income taxes and rising rates. But what people have not focused on is also the proposed limitation on itemized deductions for individuals. There are 2 key and severe limitations on itemized deductions that will come with a blue wave as well. So not only will income tax rates rise for individuals, but itemized deductions will be further curtailed. Capital gains is the second pillar that I would say would be a significant change, but that only affects taxpayers with incomes over $1 million. And that would do away with the capital gains preference item and take the capital gains rate from currently the top rate of 20% up to a top rate of 39.6, the new ordinary top rate. The third thing I want to mention is payroll taxes. And again, this escapes a lot of discussion, but can be very, very significant to a certain demographic in our population, that being professionals who have their own practices, for example, a doctor, an attorney, an accountant, self-employed consultants who pay both sides of their FICA tax, FICA meaning your Social Security tax, which is for the self-employed is at 12.4% tax. What potentially President Biden is proposing is that currently we pay FICA tax up to $137,700. And then we hit a gap. It's called the donut hole in this discussion, a new term that's emerged over the last 3 weeks. The donut hole then reinstates itself. The tax comes back in at $400,000 with no limit. And the example I like to quote for people that give some understanding of the severity of this tax is take a doctor. Doctor earns $1 million a year in their practice and pay self-employment tax up to $137,700 like everyone else. However, under these new rules that are being proposed, the difference, it would kick back in at $400,000. The difference between $400,000 and $1 million at a 12.4% tax rate is $74,000. That's an additional $74,000 for that individual on top of their income tax increases from rising rates, the haircut they're going to take on itemized deductions, et cetera. So that's a material change for people earning above $400,000. The fourth thing I want to mention, and probably the biggest fundamental change in tax law that we anticipate, is a change in the estate and gift tax area. Currently, an individual has a lifetime exemption of $11.58 million, and a married couple is twice that, $23 million. That is set to sunset in 2026. That will revert back to the old law, the pre-Trump tax law in effect before 2018, and revert back to $5 million indexed for inflation. So let's say about $6 million in 2026. What candidate Biden is proposing is reducing that $11.58 million individual exemption down more rapidly to pre-2018 levels. And in fact, many people think that he would like to bring it down to $3.5 million from $11.5 million. So a big drop in estate taxes exemptions for individuals. $3.5 million is the amount of exemption that Barack Obama and his administration proposed in 2008, 2009, and it was unsuccessful in passing. But that's where people think the Biden administration is going. The second big piece of legislation, fundamental change, is the fact that the Biden administration would do away with what we call step up in basis at death. What does that mean? A step up in basis at death means that you pay your estate tax on the amount of money that you leave at death above the lifetime exemption that we just talked about. Currently, the estate tax rate is 40%. The Biden administration talks about a 45% rate, so raising that rate from 40 to 45%. But the big change would be that people who pass away and pay an estate tax at that level above, above, let's say 3.5 times 2 for a married couple, above $7 million, they pay their estate tax. Under current law, you get a step up in basis when you inherit assets. That would go away. You would inherit the assets at the current basis, a carryover basis. And if there's great appreciation, let's say in a family business, a family farm, or appreciated investment assets that go back, maybe the family bought a significant position in Apple back in the 1990s, and that's grown and it's all appreciated asset. That will go away, and there'll be a second tax at that point, either paid at death or based on a carryover basis. So if it's paid at death, and again, the Biden team has not been clear on how they would implement this, so it's an either or. They would either tax you on that capital gain at death. In addition to the estate tax, you would pay a capital gains tax on the appreciation, which, remember, the capital gains tax rate just went from 20 to 39.6. You'd pay tax at that, or those that inherit your estate would receive a carryover basis, just like current gifts receive. And they then would when they sold the assets down the road at a later time, they would receive, they would get hit with the capital gains rate at that time. Either way, that's a big impact on family wealth. And again, I look to family businesses, farms, long-term appreciated assets is being hit hard by this rule. And the final two things I just want to mention are retirement plan deductions. Number 5, instead of getting a deduction for your contribution to your 401k plan or your IRA, you would get a credit. And the credit would be based on a 26% benefit of what you put into the IRA. And why are we doing that? Why would Democrats do that? Well, today, if you're making a contribution on your 401k plan you're receiving at the highest rate, let's say it's 39.6% benefit. Easy to calculate. But somebody in a 10% bracket or a 15% bracket is only receiving that amount of benefit on what they contribute to plans. Under this approach, everybody receives a flat 26% credit. So then again, people in a bracket above 26% will be disadvantaged, people below a 26% tax bracket. And we know about half the population doesn't pay any tax. So those people, it's to their advantage to do this. And finally, on the business world, we've been talking about individual taxes so far, but I just want to mention that the corporate rate for C corporations will go from 21 to 28%. Now remember, before the Trump tax legislation at the end of 2017, effective in 2018, the corporate rate was 35%. So we reduced the corporate rate from 35 down to 21%. An incredible drop in the corporate rate. Well, now the Biden administration has proposed to bring it back up to 28%. So about halfway back to where it was. But what also, people understand the rates increasing. It's easy to understand the numbers. But what they don't understand too is there will be a new corporate alternative minimum tax. The alternative minimum tax on corporations went away under the Trump Tax Act in 2017. This will be reinstated. And so mid-market companies with income over 100 million in book income, so larger mid-market companies, would be subject then to an alternative minimum tax based on book income. And why is that? Why would they fret about that? Well, currently, because of bonus depreciation, assets that you acquire and place in service, you can immediately write off for the next several years. And we receive tax advantage bonus depreciation for the foreseeable future. The next 5 years, it'll graduate back to 50%. But right now, it's 100% bonus depreciation. You get to write it all off. But you don't do that for book purposes. You take it over a useful life for book purposes. So for companies that are capital intensive, taxable income is going to be significantly less after the Trump Tax Act than book income because of these accelerated deductions for being able to write off additions, fixed asset additions, equipment, leasehold improvements. Why did Trump do that? Well, Trump did that to spark the economy, to promote spending, to investment in manufacturing, et cetera. So, until the current COVID crisis, it seemed to be working pretty well as far as boosting the economy. Well, this would now put a book tax or an alternative minimum tax based on book income. So even if companies did those additions that they did write off for tax purposes, they would be hit with a book tax at 15% above $100 million to book and tax. So that will hurt them. And the final one that will affect many of our Wintrust valued clients is the fact that they'll do away with what we call the 199A. I hate to use code sections, but 199A is frequently thrown around. It's the 20% deduction for pass-through entities. And when Congress and when the Trump administration reduced the corporate tax rate from 35 to 21, they said, what about pass-through entities? Most entities are pass-through entities, and especially most mid-market businesses are pass-through entities, either partnerships or S corporations. So the income flows through to the shareholders. And to address that point and make it fair, they enacted this 20% pass-through entity deduction. So instead of paying a top individual rate of 37%, you're not paying 29.6, which is simply 80% of 37% top tax rate is 29.6. So that made a lot of sense at the time. The Biden administration will do away with that so that the rate on pass-through entities, on those that own pass-through entities, will go from 29.6 to 39.6. So a rounded 10% tax increase on pass-through entities and those businesses. And I'd be remiss. I don't want to just make it sound like the Biden administration is going to increase all taxes. It sounds that way after I just discussed those 6 points. But there are plenty of credits, more than I can talk about today. But the earned income credit, the first-time homebuyers credit, renewable energy credits that the Biden administration has proposed to reinstate, or brand new credits that don't currently exist, the new markets tax credit. So that too, I don't want to get that to be lost in the shuffle, that there are positives out there. If you want to buy a Tesla, wait till January.
All right. Thanks, Dan. A lot there. So let me lead us into our final polling question, which is related to what Dan just went through. And we're going to ask you, which potential tax law change are you most concerned about? We want to get some direction from the audience. And we've got 4 options up there. You'll see in a second. So here you go. First is around the increased individual income tax rates and cuts in the itemized deductions. Second is increase in dividend and capital gains tax for the highest earners. Third is lowering the estate tax exemption from the current threshold of 11.58 per individual down to 5.8 or 3.5 million potentially. And finally, increasing the corporate tax rate from 21 to 28%. So which from our audience do you believe is are you most concerned about in the Biden plan? So please submit that. And I'm going to jump ahead. We talked a lot about taxes. I'm going to give Dan a chance to breathe over there. So I'm going to look at the investor's perspective. So Jason, what do you see as potential strategies for managing the impact of some of the tax changes Dan just talked about?
Sure. One important point is we don't know with certainty what's going to happen. So making investment decisions in 2020 off what you think may happen in 2021 is reading the tea leaves, putting your finger in the wind, or whatever you choose for an analogy. But here's what we're looking at doing for our clients in this type of scenario. The first note would be taxes shouldn't supersede your long-term financial plan. Certainly it's an input, it's inclusion, it's part of that plan. But just because a tax law changes doesn't necessarily mean that your long-term financial plan needs to be completely reworked. With a number of moving pieces, I would say don't freeze in place. The idea of the step up in basis going away is one we're focused on from an investment side of the ledger. It makes the idea of managing your taxes during the year something we do in client portfolios on a regular basis. Instead of waiting for some future date to step up basis or pay all of your tax at one point in the future. There are things you can do in terms of managing your portfolio, buying and selling assets, realizing losses throughout the year that can help to offset some of those tax implications in an investment portfolio. And of course, if you're a high earner, given the near certainty of those high earner targeted proposals that Dan outlined, particularly in terms of capital gains, if you're sitting on a lot of long-term gains that would be paid 20% this year, and you're going to nearly double your tax if you wait until next year to sell them, that would be the one area of act early if you were in that high earner bracket that from an investment perspective would make sense.
Yeah, great, Jason. Makes sense to me. Dan, what strategies would you encourage people to consider should the proposed income tax changes you and Jason just discussed come to fruition?
Well, yeah, simply stated, I'd say bracket management, first of all, for both individuals and corporations. In a period of rising rates, you're going to play the bracket. So you're going to do those strategies where you're going to accelerate income into a current year and defer deductions. For those few lucky people that make over $1 million, as Jason just said, for capital gains purposes, triggering those gains now, but also weighing the time value of money of prepaying tax. But if they plan on selling those assets in a foreseeable near future, they should do it before the legislation kicks in. And I want to clarify, it's not just a 39.6% top tax rate on those capital gains. You have another 3.8%, which is the Affordable Care Act net investment income tax on top of that. So it's really a 43% tax rate for federal purposes on capital gains. So that really should be something that those people should look at. And I'll just say the third thing I would mention is, I mentioned itemized deductions and the new caps on itemized deductions, but in any event, if you have state and local taxes, if you're on a quarterly tax basis, put those SALT expenses, those state and local tax payments into 2021 and defer those on the chance that the $10,000 SALT cap, the state and local cap for itemized deductions that came in 2018 goes away. There's been a lot of talk that the Biden administration will lift that cap, and so defer those deductions.
Great, thanks. Good ideas. Thanks, Dan. Jason, I'm going to jump to you with a question from the audience. Both Ryan Fromater and Matt Cotton asked about the future of interest rates. First of all, what direction do you see interest rates heading if the Democrats take power? And then secondly, relatedly, perhaps, is that, do you foresee negative interest rates being a possibility in the United States?
Sure. In terms of interest rates, it's less which party controls the White House and Congress and more what the Federal Reserve is doing. And we've seen the Federal Reserve pretty resolutely commit to interest rates at what they term their lower bound, or this range of 0 to 25 basis points for the next 3 years. And we can certainly see them hold tight to that near promise unless we see some sort of unforeseen economic shock or inflationary shock. Now, in terms of negative rates, the Fed's also made fairly clear that negative nominal rates, negative rates from the Federal Reserve itself are not a likely policy scenario. They have a couple other tools in the toolkit in terms of additional yield curve control or otherwise that they can try to utilize before having to get into a negative rate situation. We've, of course, already seen negative rates on a real basis in very limited timeframes here in 2020. It's possible, depending on what happens economically from here, that you could see the occasional dip of a yield intraday into negative territory. The more concerning thing for me on the rates question is really around inflation. With rates as low as they are and with the amount of stimulus we're talking about injecting into the economy and already have injected into the economy, the mid and longer term may be a greater concern for the rates picture. And you're starting to see that in the shape of the yield curve today, where the 10 and 30 year are starting to get a little bit more elevated than the short end of the curve that the Fed's holding fairly flat. Possible indication that there's some thought of future inflation at rates higher than what we're seeing. And if we start to see inflation run away, the Fed's changed its mandate and is no longer linking the full employment picture and level of inflation. They're going to let inflation potentially overrun the 2% target if needed for further employment gains.
Great. Jason, I'm going to take one other question. It's really a collection of questions from the audience because people have asked this in a couple of different ways, but folks want to know how you see the economy and the stock market performing under a blue wave scenario as predicted, and how would you compare that to sort of a status quo, continued scenario?
I think when we talk about markets, we look at a short-term impact and a long-term impact. And on the short term, generally, when Democrats come to power, you see some kind of market pullback, usually on all of those tax proposals that Dan said and articulated so well a little bit earlier. We're likely to see a bit of a market sell-off, although the larger bogey of a fiscal stimulus hanging out there and a massively significant fiscal stimulus at that could likely overweigh any sort of short-term volatility we'd get out of a reaction to Democrat tax policies. So we're likely to see in the very short term a bit of a U.S. market sell-off. International emerging markets may outperform. You get some outperformance in different sectors. So areas that are tied to the green economy or tied to infrastructure are likely to start picking up gains earlier. And we'll likely see volatility start to abate. We've certainly seen volatility spike in the last couple of days, have for the last several months. Volatility would decline, maybe a short-term increase for the first couple of weeks of November, but that'll abate. And then in terms of the longer term, the fiscal stimulus is really the key there. As you inject a lot of money into the economy, the market has liked that in the past, whether it's monetary or fiscal. And in this case, it'll be fiscal. And the infrastructure bill is certainly a great concern in that as infrastructure spending has a multiplicative effect on the economy. In terms of a status quo, we likely get a brief relief rally. We've seen the market start to position here in September and October for a Biden victory and possibly a blue wave. So similar to what we saw in 2016, we get some sort of surprise upward rally that we have split control or Republican control of the White House. Sector leadership would remain similar to what it is in 2020. We get a pullback potentially in some of those value-oriented or green sectors of the economy as the realization is we're not getting a blue wave. And we'll likely see that short-term volatility spike continue for a little bit longer, both from a geopolitical perspective with risk, but also from a market perspective. We're likely to see some more short-term volatility injected into the market structure there.
Excellent. Now I've got a bunch of questions coming through from the audience, but in the interest of time, I'm just going to take a couple more here. So Dan, I'm going to turn this back to you. Let's talk quickly about strategies regarding retirement planning. Mm-hmm. And this one comes from Tom Gates asking, as a retiree, should he consider converting a traditional IRA to a Roth IRA? What do you suggest?
I think Tom Gates is a very smart person to consider that. You definitely want to do a Roth conversion in a time in a lower tax bracket. So you want to see what tax bracket you're in. In the future, if there is a blue wave, brackets were only going to go up. We're at a low rate right now. Roth conversions make sense, but calculate it. You may want to do it over a several years too. You want to do bracket management is what I call it. So I think, Tom Gates, you are a very smart person.
Okay, I mean, one more to Dan, one more to Jason, as we're running up against our time. So Dan, in 30 seconds or less, which is a challenge to you, let's recap your top tax planning considerations for individuals if we do see this blue wave in government change.
I'll mention 4 quick things. Get your state plan in order. Take advantage of the lifetime exclusion as it exists today. It's going to go away for sure in 2026, and it could go away very, very, much sooner than that if there's a blue wave. Individuals, bracket management. Take a look at accelerating income, deferring deductions, especially your SALT deduction. High income taxpayers, that $1 million capital gains, gift it away. Make charitable contributions of appreciated assets. Use those assets in your estate planning to use up that lifetime exclusion that we just talked about, the $11.858 million lifetime exclusion. Use that. And Roth conversions. I call that the Tom Gates planning approach. Make Roth conversions today.
Okay. And advice to businesses as well?
Bracket management again. Rates are going up for businesses as well. Also consider the AMT, the new AMT, if you are a business with $100 million of income. And finally, entity review. Review what kind of entity you are. The split between pass-through entities, partnerships, and corporations currently is between 29.6 and 21%. So it is 8.6%. That will go up. Corporations will go to 28%, but individuals and pass-throughs will go to 39.6. So it's a wider gap. So it may make sense to change your type of entity, going from a pass-through entity to a C corp. So that's always something that should be considered.
Right, and that was 30 seconds or less. So thanks, Dan. All right, Jason. Finally, to you. Any closing thoughts for investors? Should we see that blue wave on the horizon?
Yes, I think it's important, and it's very difficult in the amount of volatility we're seeing right now, currently day to day in the markets. But it's important to note you can't time the markets. Short-term volatility is going to persist here. It's driven by the election. It's driven by COVID results. That is short-term volatility. It's going to abate at some point, possibly fairly quickly. And missing those upswings, those positive days that start rallies upward, go a long way to determining whether you've actually participated in the rally or not. If you sell out at this point and sit on the sidelines, you're more likely to miss gains than you are to protect against losses. So let's look past short-term volatility. And number one, stay focused on your long-term financial plan. If you are wondering what your long-term financial plan is, or you have some questions about the long-term financial plan you put in place a few years ago, don't panic. This is a great opportunity to sit down with your trusted advisor, walk through either creating or reviewing your financial plan. Don't miss those upswings on the market. And in fact, take advantage of volatility, particularly downside volatility like we've seen the last couple of days, and rebalance your assets. With tax law changes coming in the future, you're going to pay a lower tax bill this year for those rebalancing activities than you would pay next year. Always a good idea to get yourself right back onto that straight and narrow path of your long-term financial plan and work hand in hand with your trusted advisor.
Sound advice. Thanks, Jason. You know, we as I said, there are a number of questions still coming in, and we'd love to answer them all, but we want to be respectful of everybody's time. So Jason and Dan, thank you. At this point, I'm going to turn the program back over to Luke for closing remarks.
Thank you, Tom, and thank you, Jason. Thank you, Dan. Great conversation. I think the fact that there's still all these questions rolling in means that it's a really important and timely topic. And I will say, you know, most of us in the audience, we're here with our tarot cards and our crystal balls, you know, wondering what to do next. So having real experts like you who intensely study these topics is really valuable and really valued by a lot of people. I also want to thank everyone who came out to be in our virtual audience today. As noted previously, we will be doing these panel discussions quarterly, and our next session will be in late January, so keep an eye out for an invitation. And in the meantime, you can follow Jason Turner's thinking on the economy by reading his weekly market update, which you can see by following Wintrust Wealth Management on LinkedIn, or requesting your Wintrust contact to send you a weekly email with that market update. And finally, a recording of today's event will be available on Wintrust's YouTube channel. So thank you everyone again, stay safe, and very importantly, do not forget to vote. Take care everyone.